Good morning, good afternoon, wherever you are. Thank you all for joining us today for what is the second in an ongoing series of briefings in which we provide an update on the latest analysis from the Skarn Decarbonisation Quarterly. The last one of these was back in October, and then we had holidays and the January catch-up got in the way somewhat. But we are going to be doing these quarterly, so please do keep an eye out for the next one, assuming that you find this one useful. For those of you who don't know me, I'm Mark Fellows, the CEO of Skarn Associates, and I have with me today Sophie Chung, who's the lead author on the Skarn Decarbonisation Quarterly and our Director of Strategy and New Product Development. So Sophie will be doing, I hope, most of the heavy lifting with regard to the presentation, but I'll be chipping in myself too. As you will have heard if you joined our inaugural SDQ webinar back in October, the SDQ is a new service from Skarn which tracks the global progress in decarbonisation of the mining sector. We examine the global trends for different commodities, we track the underlying technologies, we quantify the costs and timelines for decarbonising power grids, electrification of mining fleets, renewable power, and other transition technologies. We also dive into the mining companies' decarbonisation targets and pathways, systematically analysing them and assessing progress versus the risk to delivery against those targets. So the second issue of the SDQ came out in December. It includes an analysis of the decarbonisation pathways of a few mining companies, so Vale, South32 and Nickel Industries. We also included some great focus research articles on the ongoing decarbonisation of the Australian electricity grid, or grids, given that they're actually more than one, CBAM, and we also had a really great focus piece on biofuels and the implications of those for decarbonisation. The third issue of the SDQ is due out in early March. There'll be a feature piece on open pit fleet decarbonisation and some of the really fascinating second and third order impacts that is likely to have on mine planning and economics. So that's going to be a really interesting subject area that we'll probably talk about next quarter. So the SDQ analysis is now evolving in a very interesting way, allowing us to make some very interesting distinctions between the strategic position of a group of mining companies that's widening over time as that coverage increases. And the key focus of the briefing today is to take a look at the traditional mineral economics type approach, if you like, of what's the carbon tax exposure relative to market capitalization of some of those mining companies. Then look at some of the impacts on value from decarbonisation, which are essentially twofold. Firstly, there's an impact in terms of social license to trade, and secondly, a direct economic impact on OPEX, CAPEX, and therefore cash flow. So Sophie's going to be talking a bit about those. And then we'll also be talking about the fact that as the market continues to evolve rapidly, the onus is going to fall to suppliers to educate their customers on the nuances and knock-on impacts of decarbonisation targets, both on their own businesses and also on their competitors. So quite a lot to cover there, hopefully something interesting for everybody. Please use the Q&A functionality at the bottom of your screen if you have any questions. There'll be 10 minutes at the end of this call for answering those. So I will be keeping an eye on the questions as we go, and we'll answer them, as many of them as we can, at the end. This content is really new and quite rich, so please do feel free to raise questions as we go, and we'll get to them at the end. So I'll hand over to you now, Sophie, if you'd like to run through today's briefing.
Thank you very much, Mark. Can you hear me okay?
I can, yes.
Excellent. Okay, so very excited about today's briefing because, as Mark said, we want to talk about some um, analysis that we've done that's fresh out of the oven, and we've never done anything like this before. What is this now? So what we've got on the slide is the top mining companies, and in the bar chart to the right, we're showing a way of a unified way of showing how these companies are tracking against their interim targets. So if you have a look at the interim columns, what we're showing there is what are the baseline emissions. So these are absolute emissions, and obviously the baseline years will differ, but let's just say it's the baseline year, and these are annual emissions, obviously. And if they deliver on the interim decarbonisation targets, then we're showing what those emissions would be. Now, they don't always go down because it depends. If your emissions targets are set on an intensity basis, then that can go up on an absolute basis. And what the bar chart shows is that in blue, you've got the amount of abatement that's been completed to meet that interim target. In green, you've got what's in progress, and then in grey, you've got what's planned. So the green and the grey categories, they've obviously got an element of execution risk, whereas the portion that's completed, let's just say that's a done deal. We'll talk more about that later. And so what we've done, what we wanted to do is come up with a dollar number, because that's our common language. And so we wanted to translate, so what is the remaining emissions, or emissions at risk, if you like, if you applied, say, a $50 per ton carbon price to that. And by the way, that seems to be the lower end of the internal shadow carbon prices that a lot of the companies are using. Then we get some sort of a number out of that. So it's $1 billion number. And here in the pink column, we're showing what is that as a percentage to market capital. But as you all probably know, the market capital is usually at a multiple of earnings or EBITDA or otherwise. And so we wanted to take that into account. So it's, and obviously the earnings multiple varies widely. We know that. But what if we then apply a 5 times multiple, just as a random number, let's say, and then you can see how in that pink column now that percentage as market capital starts to become a bit more significant. So going up as high as 15%, 8%, 7%. What if we use $100 per ton carbon price? And then you start to get some really chunky numbers. So it's interesting because obviously the carbon tax, if you're from a carbon tax perspective, the jurisdictions vary a lot in where they are on that. But also equally whether those carbon prices apply or not, we know that the companies are using an internal carbon price. And so it's a bit of a bizarre situation, but I guess ultimately it's a story about managing the midterm to long-term risk on this. Now, let's talk about some of the companies. So there's a lot packed in here, but Codelco, for example, they've probably, from a percentage perspective, they've got the largest number out there in terms of the interim targets, that they're going to be reducing 70% of their operational emissions, that's scope 1 and 2, by 70% by 2030. And because so much of the operational emissions is scope 2, they can do that by they can achieve a lot of that by transitioning to renewable PPAs. And so what's shown for Codelco, for example, what's completed is it's the renewable PPAs that have already come into effect. And then what's shown in green are the ones that are expected to come into effect in 2026. A lot of the blue portions for each of the companies is to do with the renewable it's either whether it's a renewable PPA with a third party, or whether it's a direct direct sort of contribution to building capacity, obviously. And then the portion in progress, as they complete more of this, as they take the initiatives that they have and complete them, then the risk goes down. And so that number that you see in the pink column will go down as the companies progress, if that makes any sense. I know this is quite a lot going on in this slide, so if you've got any questions, please type it in and Mark will bring it up. And just a few other points to mention, I suppose, in terms of what other primary decarbonisation levers there are. Fuel switch has come up quite a lot, and whether that's from coal to natural gas, for power plants, Grasberg's a good example, or whether that's, at the pellet plants, or switch from conventional to bioenergy, so biodiesel, biomass. And we actually wrote about that in the second edition. And then Mark mentioned this, but in the third edition, we're going to be looking into the second and the third order impacts on electrifying your mine fleet. And so if you do straightforward substitution of, we've got this, say, I don't know, 30 haul trucks at this mine, let's just translate it to an electric fleet, then that's the first order translation, and you can get some impacts to costs from that. But from our conversations, I think that there are some nuances in there. So for example, if you do that, how does that impact the cutoff grade? And then how does it change the mine plan? And so we're going to explore that in the next edition, so watch this space. Now, we want to point out that there are soft effects as well, less well defined, but at play nonetheless. And it's a little bit like a reputation premium in commodity trading. So as Mark mentioned, it's kind of a license to trade, to operate, to do business. The current market is quite binary, and here are some conversations that we've had with various participants in the market. So for example, consumers want to buy responsible copper. So for example, copper mark certified, or a different kind of assurance framework, but there's no willingness to pay a premium for it. Most banks and lenders, they want to know if a company has a target and a roadmap, but not much beyond that. So it's a box ticking exercise. And then while the EU CBAM that's being rolled out right now, it's still early stages. And so we've not had any kind of case of public hanging where there's been a penalty charged. And so for a lot of traders and suppliers, they're sort of continuing business as usual. But there are obviously some businesses that are choosing no longer to import into the EU, for example. Now, the trends, however, point one way. So right now we've got a binary kind of thing, but I think that from our conversations, once again, that the end users are becoming more sophisticated. They're doing a lot of work internally at the moment to better understand upstream emissions. Commodity traders are finding margin opportunities within interest rate from banks. So at the moment, it's more, are you trading a battery commodity like lithium or cobalt or nickel, but they are going to get more sophisticated with that, I think. And governments are obviously committing to national inventory reductions, and so they're developing policies, strengthening policies to support that kind of pathway. So now, what we've noticed as well is that a lot of the major producers, so what we're showing here is the top 10 copper companies on an equity basis. And this is what we call our E1 positioning. And so from a boundary analysis perspective, that's emissions from the mine site, all the way to concentrator, to smelting, to refining, so all the way to copper cathode production. And it's sort of and P25, P50, these are the percentiles of your intensity curve, if you like. And the diamonds represent your site weighted average, but you can see that there's a broad range for each company. So Codelco, for example, or Freeport or Glencore, they've got lots of different operations that produce copper. And so we understand that a lot of these companies are doing, work internally to come up with a commercial strategy to sort of position their story and develop that green supply chain. And as we know, a lot of these companies do have Scope 3 emission targets as well. The progress, though, it can only be rewarded if the market understands, and I think that's the challenge, but we also think that's an opportunity. So to help you navigate, I've got some examples of how company roadmaps can vary. The Skarn Decarbonisation Quarterly, we cover 10 companies now, and we're growing that number, but here are three examples. So Company A, if you have a look, they've set their target on an intensity basis, so you can see that the net emissions are going to increase by the time their target year happens, if they manage to meet their target. And so that's one type of profile. And so even though the intensity goes down, your total emissions are going to increase. Company B, has an absolute basis target and a net reduction in emissions if they meet their target, but it's hinging upon one primary initiative. And so it's one asset. If you can basically get onto a renewable electricity contract for that asset, then you've almost met your target. And so that obviously has significant implications. For example, if that asset, for example, is producing copper or ali or whatever, then it's not going to affect meaningfully the carbon intensity of some of your other products for that company. Company C, now once again, it's an absolute basis target, but what's interesting about company C is that scope 1 is a much, much bigger portion of scope 2. So if you look at the baseline emissions, the light gray, the scope 1 emissions is much larger. And we know that scope 1 is harder to abate. And so for this company, you can see that there's more in the fuel switch category. And at the same time, this particular company is having to navigate how to grow their production whilst managing it. So scope 1 is harder to abate. And so I think the market doesn't yet understand. It doesn't have a framework to say, to look at these and go, well, do I reward or do I penalize or what do I do with it? And I think this is where the onus will fall onto the producers, whether you're a miner or a cathode producer, or to basically educate your respective stakeholders and say, this is the nuance, this is where we're strong, and help navigate that kind of scene. This is, I think that I call where we are phase 1. So a lot of the initiatives that are ongoing at the moment, it's to do with renewable energy, bridging technologies like automation, trolley assist, and they're typically net neutral to net positive return on investment. And the thing is, the interim targets, they've been set mostly in the last 5 years. And so they're coming up for renewal. And in fact, we know that several companies will be reviewing their targets this year. And so what's coming, I think, is the more interesting phase. So the phase 2, which is beyond 2030, 2035. And that's about scope 1. So it's about mine fleet decarbonization. And in this next phase, I think there'll be a lot of questions around cost. I mean, there already are questions around that, but it's about understanding what that impact is. So here in this slide, I've got a summary of the different categories. Renewable energy, I mentioned before that it's mostly net positive to net neutral cost-wise. Now, there are caveats to that, obviously, but from what I understand, solar, wind a little bit more, but the operating cost is minimal once you built it. So it's about how much does it take to build it, but it's also if you're on long-term contracts, and there might be termination costs to switch over to that. And industry adoption on this, as we know, is fairly wide, and a lot of the leading producers have incorporated it into their roadmaps. Bioenergy, as Mark said, we wrote a pretty long focus piece on it for the last edition. So, and fuel switch with conventional fossil fuels, that's a different sort of category, but bioenergy we wanted to comment on because actually from an operating cost perspective, or actually with the purchase cost of bioenergy, is that it is typically at a premium versus conventional fuels, but obviously it depends on feedstock and production flow sheet. A lot of the consumers are purchasing from third parties, but some producers exploring direct investment. Rio Tinto is an example of that in Australia, and most notably adopted in Indonesia, US, and Brazil, where the domestic market is pretty well established and the government policies support blending of biodiesel and so on. We want to just put in a caveat here that as consumers of bioenergy, it is possible to decrease your scope 1 emissions. However, I think it's quite a contentious subject once you start thinking about the impact on land use change and all of that. And we know that, for example, in the EU under the Renewable Energy Directive, that we know that they're going to be strengthening their due diligence on, what is the feedstock? Are you cutting down virgin forests and that sort of stuff? And so our takeaway for that piece was basically to proceed with caution, because what the governments can essentially tolerate is not necessarily what the companies can tolerate. And so it's ultimately up to the companies to make sure that that full scope 3 emissions upstream and downstream of using bioenergy is going to be net positive impact to your carbon footprint. Automation. So we've got,
Sophie,
yeah.
sorry to interrupt, but I've just thought it'd be worth me kind of interjecting a little bit, given that we've had a couple of questions about bioenergy. It's obviously a topic people are interested in. I think it's possibly worth elaborating a little bit on some of those conclusions, because what I think is possibly underappreciated is not only the carbon accounting difficulties that bioenergy presents when you take the land use change into account, and the competition for land use as well, but also that cost differential currently between a true drop-in renewable diesel product versus a traditional diesel can be, to my understanding, can be 2 to 3 times or more in terms of price per litre relative to a traditional diesel. So that in itself is pretty prohibitive. And the drop-in component of that is really quite crucial, because some forms of biofuel are not really amenable to blending with traditional diesel. So consequently, you may have to double up your whole fuel infrastructure for as long as you're unable to commit to biofuel versus traditional. So it does present quite significant infrastructure challenges in many markets, and then there's the availability of it to think about as well. So I was going to make the point that if people on this call are really interested in this subject, we'd be really happy to have follow-up conversations. If people want to drop us a note and let us know. The content was there in the edition of the SDQ that went out in December. It's a great piece of research. Just let us know if you'd like a call about that, because we've got plenty to say. I just wanted to drop that in and give you a chance to catch a breath. Okay.
Oh, thank you. So we're quite proud of that piece that we wrote. So yeah, do shout up if you're interested. Going back to the more banal topics of OPEX and CAPEX. So automation, we're getting a few data points as well. So in an Excel sheet somewhere, because we all love Excel, we're starting to, well, we're recording. We've got over 200 initiatives now across different companies of the technology type of decarbonisation initiative and the costs associated with it. And with automation projects now, we've got enough data points to start talking about what that might mean. So depending on the asset, of course, but companies typically state like a 10% reduction in diesel consumption and efficiency and productivity gains. We've seen that number quoted as high as 30%, but I think that's an exceptional case. Capital cost, obviously, this varies a lot from site to site and depending on what kind of truck you have, but there's one data point that we've got a hold of, which is about $2 million per truck. We don't fully understand that number, by the way, so don't ask me hard questions about it. But the point is that we're getting more data is coming out on this. And many large open pit mines, underground mines, obviously, they've been in the automation game for a long time anyway, but the larger open pit mines are consistently switching over to automated fleet, and to some degree some are fully autonomous. So that's a trend, and I think that's possibly an important bridging technology to move on to a fully electric fleet, for example. Trolley assist, this is not a new technology. It's been around for a while, we know, but not particularly widely adopted. If you put a trolley assist line in, you'll consume more electricity, but you'll obviously consume less diesel. And most case studies seem to emphasize gains in productivity, so speed as well, and just efficiencies as well. Numbers we've seen generally average about $5 million per kilometer, and that's including substations and pantographs. And these are being implemented or tested to varying extents at all of the key key assets, like Los Pelambres, Aitik, Kansanshi, Escondida, Cerro Verde, and so there's a lot going on in that space. And then electric fleet, if you go fully electric, then we understand that's going to increase your power consumption 2 to 3-fold. Obviously, that will drop your diesel consumption to zero. If you've got a completely electric fleet, and for underground mines, you can save on ventilation and heat regulation and that sort of stuff. Premium, this is a new space, and so these numbers are not to be, that they're sort of anecdotal more than anything else. There's a premium on conventional diesel fleet for electric fleet, higher for larger fleet. I think I've seen as much as 50% higher, maybe more. And there's obviously very specific adoption cases going on. So, in Sudbury, for example, I think at the Creighton mine, underground, that's an example. So more widely adopted underground mines probably, but then open pit fleet with first transitioning to electric drive and then working with trolley assist, and then as I said before, that phase 2 of tackling that scope 1 emissions full on, that's going to be that next phase. So I think I've done enough talking. Just a quick, I guess a reminder more than anything else that this is a subscription product, and it comes out every quarter, and it has 3 main components to it. So we've got the insights, which Mark and I referred to. We wrote about renewable PPAs in the past and the grid evolution in China and Australia, and you can read it. Company profiles, covering 10 companies now, and that number will continue to grow. And then our initiatives database, very glamorous in an Excel format, which we love, and we're starting to capture capital and operating costs and capacity, the scope of these initiatives. So I think we can move on to questions.
Sophie, thank you. That was great. So we've had some interesting questions come in. I particularly like this one. Big mining companies' emission targets have been mostly elastic in language. Now that's an interesting statement, isn't it? Is this changing? So let's talk. I think I'm conscious that we've not got too long left here. We've only got 4 minutes, but I think this one deserves a bit of attention.
Yeah.
How would you respond to that?
Elastic. That's an interesting one. Mark, do you want to pull up that slide? Have you got that handy?
Which slide do you mean? Sorry.
In the second edition, where we've got all the targets and such. And so
yeah, I'll get it up now.
So I don't know if that's necessarily a fair statement, and that yes, sure, some companies will have made changes. But actually, when I've obviously, with the 10 companies that we cover now, I have been digging through many years of sustainability reports. And I have to say that there is consistency in how those targets have been communicated across the years. And I think that it's perhaps understanding the nuances around it. I think that's really hard, because even when I've been doing the analysis to really understand the target, I've had to read multiple times like what kind of basis is this set? Is it an operational boundary? Is it 100% basis? That sort of stuff. I think what's confusing is that there are restatements happening, especially with portfolio changes. But once again, when I tackle that and when I've looked through to essentially rebase the numbers to restated values, that I have found consistency in that as well. But I think what's true is that definitely, like, restates happen. Some of it is methodology, some of it is because they've changed portfolio. I think there's definitely gray areas in how organic growth is accounted for. So are you including all of that? Do closures count? Portfolio changes, that usually states in the, results in a restatement. So I think that, I don't know if that's helpful or if that answers the question, but I think that there is, I have found a fair bit of consistency, I would say, from year to year. But once again, I think, and this isn't true for all companies, but I think in this phase one, as I call it, where a lot of the interim targets, without a doubt, the companies had a look at what they could execute, out to say 2030 or 2035. That's usually when the interim targets are set for, and they've obviously had a look and been realistic about it and said, like, we could probably do X, Y, Z, right? So they can. To a certain extent, they've got a plan. We've not found many roadmaps where there's a massive gap, and so I think what's really interesting is going to be, say, this year, the next year, the next 3, 4, 5 years, basically, where the companies will be restating. So they're going to come up with presumably, new targets. So whether it's reiterating the current target or maybe going 5 years out, 10 years further out, that's the space to watch for, to say. And I think the question kind of goes back to this idea of, like, the reputation premium in the market, where if you say you're going to reduce by X, will you actually do it? And as I said before, the market's still trying to figure out a good way to understand that. I think I've just rambled and maybe not answered that question directly.
No, I think that was a good answer. I'm sorry it took me a little while to share my screen. I was having a bit of a technical issue there. But it's worth, I think, pointing out to everybody that we're now looking at a cohort of around 20 companies here. And at first sight, the obvious thing is that there is an enormous variation here in the ambition and scope of the targets that companies are setting. And it kind of comes back to what you were previously showing when you put up those 3 anonymized waterfall charts for the different mining companies. Companies have different issues and different levels of ambition. I think is probably the neatest way of summarizing it. And I think this analysis here really highlights that very clearly. So I'm going to stop sharing my screen now because I'm concerned it's going to create me
yeah.
more
Do we have
technical
time
issues.
for? I know we've just gotten past 4 o'clock, but I don't know if we've got time
So
for.
one more
other
question then. Just give us a quick rundown on the content for the next edition of the SDQ.
Okay. From an insights perspective, we're going to be looking at the bill for C59. So that's, I think, been referred to as the greenwashing bill in Canada. So we're going to do a little piece on that. As Mark and I have referenced, we're going to look at the impacts, the second and third order impacts of electrifying your mine fleet. So not just a direct substitution, but what does that do to your mine plan? So we'll be exploring that, and we'll be having a look at what we think the Peruvian grid is going to do. So those are the insights. I think we've also got a small piece on secondary copper production and the technologies. And then on the company analysis, we've got Codelco, Grupo Mexico, Freeport, and Antofagasta. And I think as from a commodity trend analysis, we're going to be looking at copper and cobalt again.
That sounds like enough to me. So thank
Okay.
you. So guys, thank you everybody for attending. I hope you found this useful. It's been a very enjoyable experience to present. So thank you all for coming along. Please look out for us on LinkedIn, follow us there, reach out to us via our website or via LinkedIn. We love to talk about this stuff. It's what we do and what we love. We will be in touch with details of the forthcoming webinar. If you are going to PDAC in Toronto in the first week of March, please let me know if you'd like to meet up. We will be there. We will be presenting a live event at the offices of A&O, Shimon and Sterling again this year, and it'd be lovely to meet you there if you're going to be around, any of you. So thank you all, and we will be in touch.